Well, good morning, and again, we're very pleased to have all of you with us this morning, and we have a great panel. We're going to ask each of our panelists to share their information with you, and so we'll hold questions until all four of them have had an opportunity to share with you this morning, and then I'll help to direct the questions so that we can answer all of your questions and really engage in hopefully a very positive dialogue about this important issue. Let me briefly introduce each of our four panelists. There is information on the back of your agenda in your packets this morning so that you can learn more about our panelists, and I'm sure each of them will tell you a little bit about the organizations that they represent. We're first going to hear from Leticia Mathis. She is a community loan originator with Commerce Bank Mortgage, and she's going to share some information about the current lending environment and about down payment assistance programs for older adults and older homeowners. We're going to then hear from Pete Mendenhall, and he is a certified aging in place specialist with North American Savings Bank, and he's going to tell us about reverse mortgages and the opportunities that they present for older homeowners in our community. Then Michael Snodgrass, who is the Executive Director of the Builders Development Corporation, is going to share with us some of his broad experience in working on renovations and new construction in neighborhoods for both sale and rental of housing. And then finally, Chris Vukas, who is a Senior Program Officer with the Greater Kansas City Local Initiative Support Corporation, or LISC, is going to share with us some information about affordable housing development and financing opportunities in that regard. So we will start with Leticia.
Thank you for coming out here this morning, and thank you, Kathy, once again for extending the invitation for me to come up here and to discuss a couple of topics. One is some of the mortgage challenges that we face when it comes to lending, and then also the down payment assistance programs. So, that being said, again, I'm the community loan originator for Commerce Bank and Commerce Mortgage. My role is twofold. I actually do originate mortgage loans, and on top of that, I also get out in the community to create awareness of our down payment assistance programs that we offer. Moving along, what I'll do is I'll kind of go through some of these bullet points of some of the challenges that we face when it comes to the mortgage lending. Credit scores have significantly impacted consumers with the recession, loss of jobs, not being able to pay on notes, whether it's auto loans, credit cards, and what have you. It has decreased in the credit score average. So, of course, that's one of the items that does impact and becomes a challenge when it comes to the lending. Debt-to-income ratio is another indicator that we look at when we go to do a mortgage loan. And basically what that is we take all of the current outstanding loans from pulling from the credit report and then add the proposed mortgage payment and divide that against the monthly payment, monthly income that they're earning. Spits out a ratio, and our cap is currently at 45. However, there is a little gray area depending if the consumer can meet some of the requirements, be able to go over that 45%, but that is generally what we strive to stay within. The down payment can be sometimes a little misleading because a borrower may have their 5% down payment, but then don't account for closing costs, which then can be an additional $2,000 to $5,000 on top of their down payment that they're looking to proceed with the mortgage. The transaction type, depending on what it is that they're wanting to do, a consumer may want to do a 15-year mortgage. With that being said, obviously the mortgage payment would be a little bit higher, but if it does not fit within the product guidelines of 45% debt-to-income ratio, then our consumer may have to consider doing something else, such as a 30-year term instead of a 15-year term. The loan-to-value also kind of plays into more or less like when it comes to refinancing and also with purchases as well, but I'll kind of do the example with the refinancing. For a while there, we weren't seeing any refinancing coming through, mainly because of the value of the housing had declined as well. Although we're starting to see an increase on that. However, if someone is just wanting to refinance a home loan with Commerce Bank, and we can only loan up to 95% of the value of the home. So if they owe $100,000 and the appraised value comes back at $100,000, we're only going to be able to loan up to 95%, so that'd be the $95,000. So then the consumer is faced with either not being able to come up with the funds and not proceed, or have to pay the difference to be able to make that mortgage loan work. The premium mortgage insurance is what home buyers have to pay in order to protect the lender in case of a default. The premium mortgage insurance is basically determined or calculated by the loan amount and their credit score, and that's how they generate the price for that. So an individual that has a 660 with a loan amount, same loan amount as someone who has a credit score of a 760, the individual with the 660 will end up paying more on that premium mortgage insurance. And then, of course, the appraisal issues that we come up with, and then within that, the comparable sales, foreclosures, and short sales, and then repairs. With the appraisals, of course, that's been a decline for many individuals that are looking to refinance, and if the value of the home isn't there, then they have to make that decision as to whether or not they wish to proceed with doing the mortgage process. We do have to find comparable comps within a certain radius area. Foreclosures and short sales definitely are ones that we can do. However, they do have to pass a full appraisal from a safety standpoint, fire hazard standpoint. If windows don't open, then it's a fire safety hazard. If there's missing rails in a home, it could be a safety concern as well. So, minor things like fixtures missing, carpets being torn and stuff like that, those are things that can be overlooked when it comes to the short sales and the foreclosures. And nonetheless, will have to, at the end of the day, be repaired if there are some safety concerns in order to proceed with the mortgage process. We do abide by the Fannie and Freddie Mac guidelines. We do the FHA, VA, conventional, jumbo, adjustable rate mortgages. I will kind of move into the my specialty here, which is the community programs that we offer. The first one being the CHIPS, which is the Community Housing Investment Program. In your little packet, you have a map coverage area. These are going to be, there are some income guidelines, caps, if you will, in order for a borrower to qualify to receive the down payment assistance program. For the CHIPS, it can range anywhere and up to $25,000 that they can receive as a down payment for their home. And I have also provided the website and phone numbers, and of course, you can utilize me as a resource for additional information. Kind of didn't provide the very details of the process itself, mainly because currently it hasn't been rolled out as far as how much dollars are going to be allocated. However, that will come in March, and we'll be able to resume on taking applications. In second quarter sometime. So we will be able to resume in taking applications for that program. But like I said, it is a very specific targeted area, so it's going to be for someone who's looking to locate in this area, and if they qualify through us, then they would be eligible to receive that down payment assistance. The second one is the KC Dreams, which is also included in there. This one also is, this provides up to $20,000 or 20% of the purchase price of the home. It does cap at $20,000. And with both the CHIPS and the KC Dreams, there is a a commitment of term of staying in the home so that they don't have to face of having to pay back any of that down payment assistance that was provided. So there's some requirements there as well. And this one is a little bit more broad as far as the coverage area. It does provide coverage in up north in the Gladstone area, Briarcliff, Truman Plaza area, downtown, heart of Kansas City, and out to Raytown and Grandview and Hickman Mills. In there, again, like I said, I included the map and then additional information of the website and email and where you can go out there and look. Both programs at this time are not accepting applications. However, we'll be doing picking those back up in second quarter. So if there's any questions around that, I'd be happy to help. But I just don't know if they're going to change any of the requirements for this year. So I just kind of wanted to provide just a little bit about that. And then there's also some grants out there that are available to consumers that to help with the closing costs on that. I provided my information up there once again. And then also there's a lot of general information with respect to mortgages out on our website. There's rates and there's financial calculator that one can find and apply or also submit a pre-approval. And like Marlene said, we will hold off for the questioning at the end. So if you have questions, please write those down. I'd be happy to answer those at the end. And with that, I will hand it over to Pete. Thank you.
Good morning.
Good morning.
I want to have a show of hands. How many people have heard of a reverse mortgage? Keep your hands up in the air, please. How many people know of somebody that has one? That's why I'm here, because a lot of times we hear things, but we don't know what we don't know, is what my grandfather used to tell me. He said a wise man knows he doesn't know what he doesn't know, and then he learns it. So what we want to talk about a little bit today is the home equity conversion mortgage, which is also known as the reverse mortgage. Really, it's a tool. And for a long time, people thought of reverse mortgages as a last resort loan. Somebody that was in a situation that needed it. Today, because of a lot of changes to the program, I call it the new reverse mortgage. And it's really more about funding longevity. So that's really what we're going to talk about, because there's many ways you can fund longevity. This just happens to be one of those tools that you could use. So that's what we're going to talk a little bit about. And these presentations, you'll have access to them later from the website, because there are pros and cons. And what I've tried to do here is talk about many different things that we have to think about as 10,000 people a week turn 65. And that is, how are we going to fund ourselves living in our home? How are we going to make those modifications to the home if we need to? How are we going to pay for skilled nursing? How are we going to pay for our loved ones to go and get special care if they need it? How are we going to buy a new home if we need it that better suits our needs? That's really what we need to be thinking about, and there's many ways that we can possibly fund that. Reverse mortgage just happens to be one of those. So there are pros and cons with both. There are some requirements to qualify for a home equity conversion mortgage, reverse mortgage. Recently, both borrowers had to be 62. We had some changes now, and that allows us to have what's called a non-borrowing spouse. So only one of the married couple has to be 62 or older. The reason the age is specific is because that tells us how much we can loan you by guidelines that have been given to us by FHA. The older you are, the more money I can loan you, and it makes sense, right? Because you don't make any payments on this loan while you have it. It is a non-recourse loan, and it's never debt. You don't have to debt service the loan during your life or your partner's life, as long as they live in the home. So that makes sense that if you're going to live 20 years, the bank wants to get paid back in the future, right? So we can loan you less money. If you're older and you're going to only live for another 15 years, we can loan you a little more money. But it's important that you understand that the loan is non-recourse. is merely a loan, so you still stay on title, and the loan is fully insured, because people always ask me, Pete, how is it a bank can loan us money today and ask us to never pay it back in our lifetime, or ask our heirs to? Because the loan is insured. So when the home is sold, that's when we get paid back, upon the last of our clients moving away from the home or passing away. There are a lot of benefits to a reverse mortgage compared to conventional financing. One of the main ones is, again, not having to make that monthly payment. If you have an existing mortgage, and I don't know what the statistics are, I was in a training yesterday where it says that most people have had 8 mortgages in their lifetime. And every time they refinance, they end up extending the term to 25 or 30 years. Well, do you know anybody that could be 62 years old that has refinanced and now has a 30-year term on a mortgage? That means that they're responsible for those payments even if the value of the home goes down. What a reverse mortgage allows them to do is possibly refinance that loan into a situation where they make no monthly payments. So if you want your last refinance, how would it sound good if that last refinance is no monthly payments? All that would do, though, it doesn't lessen the debt load on the home. What it does is allows you to free up some income on a monthly basis to offset expenses. Now, some people have a free and clear home, like my parents, for example. Their 401 turned up to be a 101 real recently, and they now are concerned about what they're going to do. My dad thought he was helping the 5 of his kids by saying, you know what, let me stop making these payments on my long-term health care insurance because I can save that money every month and do something else with it. I sat my dad down at Christmas and explained to him, Dad, the problem with that scenario is I can come up with a couple $100 every month. I can't come up with $80,000 if something happens to you. So in that case, he wants to have a line of credit that allows him to be able to go when he needs money and draw from it. And a lot of people say, sure, we can go get a home equity line of credit. The problem with a home equity line of credit for my father is he's not currently working. So he doesn't qualify for a home equity line of credit as easy as he'd like, or if he is able to get it, the bank's going to ask him to make an interest payment every month. After 10 years, that home equity line of credit will convert to a conventional mortgage and start having mandatory payments. So in his situation, he said, Pete, I think maybe this line of credit might be something for me to look into. And I said, well, that's pretty good, Dad. I appreciate you now thinking I have a little good understanding about what may be able to help you. But really what he didn't understand, and what a lot of people don't understand about a line of credit when it comes to home equity conversion mortgage, is that pile of money that you qualify sits over on the sidelines. It has a growth component, so that pile of money that you can future borrow from grows day over day and it compounds. Until you borrow from that pile of money, you do not owe that money back. Okay, and it's not treated as income. So there's a lot of benefits. If I could tell you that you could set aside X number of dollars today that will grow for the next 10 to 15 years, guaranteed at 4.5% compounded and tax-free, when would you want to set that program up? About 10 years ago. And that's one of the good things about the program, but many people misunderstand the program because we all have our black eyes, right? Don't we all understand about what the biggest thing that's happened here in Kansas City, and we made national news. There was a reverse mortgage home that was foreclosed on. And we've all seen that, right? And that's bad news, so that leads. Bad news seems to lead in any news broadcast that I've seen. But what happens if you own a home that's free and clear and you don't make your property taxes, pay them? What happens to your home? It gets foreclosed on. So what you need to understand about a lot of what you hear, there is a rationale to what's happening that maybe the emotional side did not understand. The reverse mortgage did not foreclose on the home. The home was foreclosed on for lack of payment for property taxes. Now, in a normal mortgage, sometimes you can escrow property taxes, right? Because you're paying the bank every month and they take a portion of that money and set it aside in the escrow account and then they pay property taxes on your behalf. In a reverse mortgage, we're either giving you money every month or allowing you to have a line of credit or not to make a bank payment. So since you're not sending us money every month, we don't have an escrow account that's set up to actually pay your property taxes. So the one thing you're responsible for at the end of the day is not debt service on your loan or interest payments, but your property taxes and your homeowner's insurance. Okay? And as of March 2nd, we're going to have some new rules coming out, which is called financial fitness, which will be the first time for our program where we are now going to have to start looking at the ability to make those payments. And if you're not able to make those payments with your current circumstances, reverse mortgage will still help you, but we'll set aside mandatorily some money to pay those property taxes and insurance, which should prevent any future foreclosures, period. So we hope that will help in that situation. Talk a little bit about the safeguards. Education is always important, but we also cannot work with a client until they've done counseling. And that counseling session can be either done face-to-face or over the phone. But I cannot work with a client, and by the way, I originate loans every day. I happen to also oversee our sales division, or I call them our advocates, because I'll tell you in a minute why we're not a sales division at NASB. We're more advocates. And then I oversee for all 50 states. I happen to carry the designation for CAS, which is Certified Agent in Place Specialist, and also Certified Reverse Mortgage Professional. And there's about 70 of us in the country, and we happen to have 2 at our bank. So that's pretty strong. But the reason I say that we educate is because the most important thing, particularly talking to you today, is this may not be a program for you, but you may know somebody either through a relationship or somebody that comes to your organization that it could be a potential solution for. And that's why I ask you to find out the facts. And I've put a couple just high-level things in your folder. I put in a little bit of basics about the program. I also put in the National Counseling on Aging, the 8 myths. And this would be really good to read because this is going to share with you a lot of the misunderstandings. We have pros and cons of the mortgage, and then I also put in the new HUD chief talks about reverse mortgage, and I put that article in too. So I think that'll be good reading for you. But here's the thing I want you to understand. There are really, reverse mortgages have been around since the 60s. The home equity conversion mortgage only came into existence in '89 with Ronald Reagan. So a lot of what you have heard in the past or a lot of the hush talked in the rooms has more to do with the programs that's been around since the 60s, not necessarily the home equity conversion program that started in '89 that's mandated and controlled by FHA. And here is the important thing. The amount of money that you qualify, you have choices of how you use that money. If you have an underlying obligation or a lien against the home, that has to be paid off at closing, right? Because the reverse mortgage cannot be subordinated. It needs to be in first position. So if you have an existing first or a HELOC or something like that, that has to be paid off at closing. So when you qualify, you have to qualify for enough proceeds to pay that existing mortgage off, and that's why we call that a refinance, right? A refinance with no new payments. The other way to do it is you can set up a tenure program, and you can say, Pete, I have a free and clear home. I would like you to tell me what money I can qualify for the rest of my life every month and let me know how much you can send me. And that would be the tenure program. The term is to say, well, Pete, I really need money for the next 10 years because I don't want to start drawing Social Security until I'm 71 or whatever the reason is. So tell me how much I can get every month, tax-free, not counted as income on a monthly basis for the next 10 years. And you can do that. You can open up a line of credit, which means that that money sits on the sidelines and you borrow from it as needed to offset expenses. The other is you can take a lump sum at close if you have some issues that come up and you need money right at close. And then anything else, modified tenure or term. But what I like about the program is you can do a combination of all three. If you have some HELOC that needs to be paid off at close, that'll get taken care of, and that's considered cash at close. Even though it doesn't go to your hands, it pays it off. You can then start drawing a monthly amount of money, but remember the monthly amount of money that's coming to you is coming from your line of credit. So if you have a happenstance or some circumstance that happens in your life and you need some additional funds, you're able to actually pick up the phone and get those funds wired to you so that you can get them ad hocly when you need them. So it gives you a lot of flexibility of how you spend down that money. We're going to save questions and answers to last, but what I want to leave you with is it's easy to hear the confusion and be I guess, excited about the negative sensationalism of any tool that's out there. Remember, the tool is only as good as the people that use it. So what you want to make sure is that you're well educated about the tool and its uses. You also want to make sure that when you partner with somebody to deliver that tool, they have a good understanding of how it's going to work for your client. And the last thing I'll say about NASB, we chose, when we got into the space, we chose to start compensating our loan officers based on the value of the home, not the size of the loan. Because in a reverse mortgage, the way the bank gets paid is like any bank. We get paid on the size of the balance of the loan when it's issued to Ginnie Mae, which is how we get paid. The problem is that we're paying our loan officers on the value of your client's home. So therefore, they truly are an advocate working for the client because they have no difference to whether the client takes no money at close and leaves all the money in the line of credit, or whether they take all the money they need at close. And that is important for you to understand when you choose a partner. Make sure you know the program, make sure you know the partner you're choosing to work with, and be aware that how they're compensated could affect what they're going to try to solicit to. And always be comfortable realizing that any of your clients, before they can do a reverse mortgage, have to be counseled. And again, that counseling session is mandatory, and it is done by a neutral third party that's been approved to do that. And that is another great education process. And every counselor is promised to be with the client through the transaction. So if during the transaction there's a question that the client or you feel that you don't want to ask of your broker or bank that you're partnering with, then you can always call the counselor. So really that's what I had to do. Thank you very much.
Good morning. My name is Michael Snodgrass. I'm the Executive Director of Builders Development Corporation. I'm going to talk a little bit differently than our lenders in the room in the fact that, we're not a lender. We're a community development corporation, 501c3 nonprofit. So what we do is rehab, build, and otherwise revitalize neighborhoods throughout the metropolitan area. So our number one mission is the production of affordable housing and revitalized neighborhoods throughout the region through innovative, energy efficient, and entrepreneurial business principles. We were formed in 2005 by several members of the Home Builders Association, Fannie Mae. I think there were some lenders in the room, some realtors. At that time, if you remember, the market was going full bore in terms of housing, and these were more philanthropic-minded individuals that wanted to give back into areas of greater Kansas City. Of course, then the market crash came in 2007. All that kind of went by the wayside, which leads me around to I've been doing this for about 23 years. Back when I decided to come back down to Kansas City from a brief stint up in Lincoln, I called the home builders and said, what'd you ever do with that 501c3? And they said, well, it's still there, but really not active. And I said, well, I have an idea for it, but we want to reform it to take it more metro-wide and even beyond that at this point. So we reformed it back in 2010. I started in 2009. Currently, we're building and rehabbing homes throughout the metropolitan area and beyond. We do some 55-plus housing, a lot of new construction rehab, with our focus, of course, on energy efficiency. And there are several partner cities in the room that I see. So we work strongly with the cities in determining what their needs are and then trying to help them accomplish that. I'm not going to go through all these accomplishments. It's, you can read the fact sheet that's in the brochure, the handout. But I did want to share with you a couple brief slides. This is not in Kansas City. This is a project that we had actually down in Hutchinson, Kansas, a 36-unit LIHTC, low-income housing tax credit. deal. Oops. That we were able to build primarily just using low-income housing, the historic low-income housing tax credits. Like I said, 36 units, energy efficient. Our HERS rating, for those that you know that HERS was in the 70s, so it was pretty energy efficient at that point. We actually have some other projects now throughout Kansas, one down in Ulysses. Does anybody here from Ulysses? Ulysses, Kansas. Anybody know where Ulysses is? Okay. For those of you that know where it is, it's a long ways from here. And we have both a USDA project for seniors that we're about ready to propose. We have a low-income housing tax credit project that we're submitting in February. And we just received some funding from the state of Kansas for some senior housing down there from the moderate income housing program. So there are several tools to assist neighborhoods and cities that I will go over. Briefly, they're the Home Program, Neighborhood Preservation Act, Abandoned Housing Act, and then of course Federal Home Loan Bank. There are others that I won't probably go over, but if you have questions on it, I might be able to answer them. I can probably tell you the right person to get in contact. Land banks, of course, are a good tool to assemble the property in order to do some of your projects. There are city and county housing trust funds that are being developed all over the country. I'm not sure if we have any here locally, but that's something a city or a county can develop. Of course, there's community development block grant funds, and then, of course, to go along with that, you can do that in housing and neighborhood revitalization strategic areas. And then, of course, some cities have put general funds towards affordable and or senior housing. So just some brief pictures of some homes that we were able to acquire and rehab. I'm not sure these transitions, we're not going to probably see very many. There's a good before. This was actually a HUD house we did down in Belton. It was so far gone and so cut up, it couldn't be saved. The city wanted to condemn it, had condemned it actually, and we were able to bulldoze it and then build this new house, energy efficient with geothermal heating and cooling. Of course, you have your rain barrels, all energy efficient appliances, anything you can and will do energy efficient we did on this house, and all of our new homes for that matter. All of our new homes are built to I don't know if you know the Energy Star standards. Energy Star 3.0 is the minimum that we build to. Here's another good one. This is actually a house that was another one in Belton that a bank owned. Called us up one day and said, we have this house that we'd really like you to take a look at. And so it was in, as you can see, pretty rough shape. So we said, well, the lot is good. I guess we can use the lot. And we built this new house on its place. It made a big difference in that neighborhood and really changed the entire downtown region. Here's a couple other new ones that we built over in Sugar Creek. We built 2 there. And we have several other examples throughout the metropolitan area that we've been able to acquire, rehab, and or build new. So the home program, there's some HUD officials here. I don't want to bore them with the home program, but there are several participating jurisdictions here. You have to be over 50,000 people. I think these are the 4 in the metro area: Independence, Johnson County, the consortia, Kansas City, Missouri, and Kansas City, Kansas. States also receive home funds. The state of Kansas primarily uses it in conjunction with the low-income housing tax credit program to help combine those 2 programs. The state of Missouri also receives home funds, but they don't particularly do a lot in the state of Missouri in terms of individual housing. They'll use that for down payment assistance, I believe, in the state of Missouri. Some of our energy efficient features that we do, of course, again, I won't read all this, but these are items that we typically put into it. Geothermal heating and cooling, it really depends upon the lot and where we're at. We may not put it in every house, but every house will be at least Energy Star rated. This is an interesting one that we've been involved in for the last couple of years now. But the state of Kansas and the state of Missouri have a program called the Abandoned Housing Act. It's a judicial process where we as a nonprofit can petition the court to acquire property that may have been sitting empty for 5, 10, 15 years. In many cases, it's they've been on average about 10 years, I guess. It can take a few months to acquire, but once you acquire that, then you have to provide the court with a plan on what you're going to do to the property in order to make it more livable, and then what your resale program is. The previous owners have a 1-year redemption period. They can come back and get it, but if they come back, they have to pay us every dime we put into it. So if they haven't been able to keep up the property, they're probably not going to come back and try to get the property back. They could, but we haven't had that experience yet. So this is a house, actually, City of Independence is here. So this is one that we took through the Abandoned Housing Act. We didn't have to go all the way through the judicial process because we were able to find an heir and get her to sign a quitclaim deed to the property before it got all the way through the judicial process. But it's one of our bigger rehabs in terms of it's in the Truman Historic District. It had been sitting empty. The house was from floor to ceiling with junk. It was a hoarder that lived in there for, and if you have dealt with hoarders, they're in pretty tough shape when you acquire these. So it took us 4 big 40-yard dumpsters to haul out the debris from that house. This was the garage, a lot of syringes, a lot of unsavory elements. Used to use this. We stripped it down, and now this is, again, what it looks like today. Some of the interior photos, with all the hardwoods. You can't rebuild this house. And that's why the city was adamant about saving it as much as possible, because all this trim was original. So they were built in. Some of it, the roof had collapsed. Part of it had collapsed the floor. So we had to redo the floors and ceilings, and even the built-in shelves near the window. Some of it we had to reconstruct and make it whole again. But again, it turned out really well. We're pretty proud of this property. We've also acquired several other properties throughout. We just acquired our first one in Raytown through that process. And we've acquired several others in Independence at this time. The first thing we try to do, usually there's a big hole in the roof that is causing problems. So as soon as usually the day we are able to get the judge to sign the original deed, then we go in the next day and tear off and put on a new roof. At least they stabilize it immediately, and try to show improvement to the neighbors who are usually fairly upset about this vacant house that's been sitting next to them for a number of years. Combining that program with this next program in the state of Missouri has worked out pretty well, or I think will work out pretty well over the long term. The state of Missouri has a Neighborhood Preservation Act. It's through the Department of Economic Development. It's only in certain census tracts, but you can go on the DED website and find if you have cities with census tracts that qualify. There are a couple different categories. There's the eligible, and then there's the distressed. If you're eligible, you can get a certain percentage of your rehab costs, up to $25,000, reimbursed through a tax credit. It's a 100% tax credit that then we as a nonprofit can sell to somebody like Commerce Bank for 90 cents on the dollar, and we get cash then that helps to fill our gap in doing these types of projects. If it's in a distressed neighborhood, you can get 35% up to $70,000 reimbursement via the tax credit. Again, if you get $70,000, you'll get $63,000 in cash. We will anyway, under our current agreement with Commerce. Then that will help to plug these big holes that exist whenever you take on these type of projects. You know, the Federal Home Loan Bank also has programs both in the state of Kansas and the state of Missouri. The Missouri one is administered up in Des Moines. Of course, Topeka is the Kansas one. There's affordable housing advisory committees that meet, and they have programs. You can go on their websites to find programs that will allow for both senior housing and any type of other type of housing that you might need. I know the application process for Des Moines is coming up here pretty soon. We're going to be applying this year with the city of Raytown and probably the city of Independence for some employer-assisted housing programs to help to augment and allow some of the employees, both in the school districts and or the city governments, to acquire these and buy a home. You know, we've had some pretty good luck with some of the funders that are out there. It's still hard. It's not like the old days. They're not doing 85% loan to values anymore, where you could fund the entire cost of the acquisition rehab pretty much, and then you could maybe make a little bit of money. Typically, they're looking for this other source of funds. That's why the NSP program, the Neighborhood Stabilization Program that's just ending now, was an important program because we could use that, about 50% of the NSP program, along with 50% of bank funding, then to do some of these housings. And it made it pretty palatable to lenders. If you can bring other funds to the table that you're using first, you're using their money last, but they get their money back out first. So they're pretty agreeable to using those type of things. But you can use that with home. We use it in Johnson County. We have banking partnerships where we're acquiring dilapidated properties and homes, rehabbing them, using usually about 60% bank funding, the other amount in home, and then when we sell it, we try to recapture as much of the home funds as possible to then use on future properties. Of course, there are government programs. The government programs federal government in particular, fluctuates over time. Even the state ones, you know, with the Neighborhood Preservation Act, are governed by the state, and so you're always at the whim of whatever political wind is blowing at the time, whether they're in favor or out of favor. The home program, you know, is about half or a little bit less than half of what it used to be, which is a shame. You know, we'd like to see more advocacy around increasing the home program because we think it's a valuable tool. It's really one of our only tools in a lot of communities to do affordable housing. But you know, they're less reliable, but they are there. So if you have questions about anything that I've talked about, I can probably answer them during the question and answer period. So with that, thank you.
All right. Good morning, everybody. Again, my name is Chris Bucas. I'm the Deputy Director of Greater Kansas City LISC. And I appreciate having two other finance folks on the panel, so it's not just me, the boring guy that everyone kind of eyes glaze over when I do my presentation, so that's great. Today I want to talk a little bit about, start off with our organization, what we do, talk a little bit about the state of Kansas City in terms of the work that I do related to affordable housing. So LISC is an organization, it's Local Initiative Support Corporation. Terrible name. We recognize I've been trying to get them to change it, but you know, we're stuck with it for now. But what we did, we were started in 1980. A bunch of foundations got together, Ford Foundation, Kresge, a bunch of the big guys, and they said, you know, we need to figure out how to invest and entice private capital to invest in affordable housing in New York and Chicago and some of the bigger cities. There's a lot of opportunity. But for the private market, they just see the risks are still there. So they created a loan fund. I think the first one was right around $5 million. And they went out and they tried to work with local developers to build affordable housing. What they found was really the model that they kind of stuck with was not necessarily for-profits, but helping to fund nonprofit community development corporations, or CDCs, as they're known across the country, to really do that kind of development, to do the affordable housing, the mission-driven, community-driven projects that the cities can help rely on these organizations to do the type of housing that we need. So LISC was supposed to be a 5-year pilot program. We just had our 34th year, and we've invested roughly $1 billion in low-income communities just last year. We're in 30 cities around the country, and we're supported heavily by local foundations. Here, the Hall Family Foundation is really an H&R Block, helped bring us to Kansas City, and they're our 2 biggest funders, along with the Healthcare Foundation of Kansas City, and we're really happy for their support. So what we do, I'm not going to go into all that we do because I could be up here for half an hour talking about all the different programs. But what I do is I'm in charge of all the lending here in Kansas City. We invested about $8 million last year locally in loans, another roughly $1 million in grants. We receive a line item budget from HUD every year called Section 4, which that's used for capacity building of community development corporations. We used to have about, 15 or 16 of these community development corporations in the Kansas City area that did this kind of work. For years, we had, LISC funded a variety of organizations. We roughly have about, I would say 5 maybe left in both in Kansas and in Kansas City, Missouri, that are able to really do the kind of acquisition, rehab, remodeling of housing, of affordable housing and workforce housing, including senior. So what I get to do is I get to work with all the fun stuff. So like all the deals that I look at have hair on them. They're like the deals that no one wants to do, that the banks are like, this is crazy, I don't know, like this, there's no way that this is going to work. And so they usually call me and say, or they say, call LISC because LISC can help you out. So what a CDFI is, so we're a certified community development financial institution, the largest one in the country. We're a nonprofit lender, essentially. We're a mission-driven lender. We lend only in low-income communities. At the national level, we have a loan pool of about $200 million at any given time that we loan out. Again, only low-income communities for a variety of projects, retail, commercial, housing, healthcare facilities. We also raise grant funds to help reduce interest rates and provide grants to charter schools through folks like the Kauffman Foundation. So we do a lot of different things. But here in Kansas City, the majority of my day is spent filling gaps for projects or working with nonprofits and sometimes for-profits to fill the gaps in their deals. Because like we see on the east side, the economy's not there. I mean, so it has to make economic sense for a for-profit or a nonprofit developer to come in and do a deal. And for years, the cities thought these CDCs, this was the model. So we have these nonprofits, we can funnel these federal funds to these nonprofits. They can do development work very similar to for-profits, and they can generate fee income from the sale of those homes, even though for the majority of them are selling affordable housing. Well, that works great in New York, in Chicago, and Minneapolis, and California when the land is worth something. In Kansas City, the land's a negative. So in those places, the city can give the CDCs a piece of property that they may have for whatever reason that's worth $400,000. These nonprofits come in, build something really nice, and flip it and sell it and make $1 million, and that could be their operating budget for the year. That was kind of the idea when CDCs were created. The reality is in the Midwest, it doesn't work that way. The land costs are expensive. The CDCs are struggling. Less governmental funding means less, to the CDCs. And so if we want that model to work, LISC, is one partner that comes in and helps allocate resources to these CDCs. But again, so what I look at is gaps. So when we're looking at single-family housing, this is tough. So again, we focus in on affordable, we call it workforce housing. People call it low-income housing, but really if we look at the average wages of the folks in our 20s, it's 10% or 15% less than it was 20 years ago. Folks are making less, and housing keeps increasing. So what do we see? We see gaps in new construction. So Michael Snodgrass may be able to build a house for $185,000, a 3-bedroom, but in some places in the city, when you appraise it, and we had the situation, it was appraised at like $110,000. Well, how does anyone get a mortgage on that? I mean, you can't. Again, there's a gap there. So that has to be filled one way or another. What we also see after the downturn in the economy was the appraisals are artificially low. And sometimes that's because there hasn't been a lot of comps in the area in the past couple of years. Sometimes that's because who got blamed oftentimes during the bubble was the appraisers. They got raked over the coals in terms of, well, these are artificially high. And so the appraisers, and oftentimes, especially in low-income areas, the appraisals are low. Again, I got back to land value, the carrying costs of a piece of property. The value of that to a lender is zero. So they can't come and say, well, I have this land, it's worth $300,000, so you loan me $150 so I can renovate this house. It doesn't work that way. They start with zero, and they say, well, you need to put some equity in. So either the CDC or the other entity or for-profit has to put equity in before they can borrow on that home to renovate it. The other piece is a lot of the federal programs, like home, it's hard to find qualified borrowers. So they may make just a little bit over what the area median income is. That's also somewhat counterintuitive to rebuilding some of the urban fabric, because sometimes you want people that aren't making, that aren't low income to move into areas and are willing to be kind of the urban pioneer. And so when you subsidize some of those homes using some of these programs, it's really difficult to find qualified borrowers. And then the biggest tool that I think cities use is the Community Development Block Grant Program. It's their most flexible tool that each city receives an allocation of these funds based on their low-income population, and they're able to kind of use these for various projects to help support low-income folks and also housing. However, there is some uncertainty from the national level on funding. It keeps reducing over and over again. And so what you're left with is you see shrinking CDBG, which is, again, the main tool, and then the cities are having to either use money from their general fund to help support some of these activities. But so, again, it's really the uncertainty around that is unfortunate because that's, again, the biggest tool to help support housing. And, again, the reduction of CDCs. So, we see these great organizations that have done these great things, and you see some of them, the shops at Blue Parkway. And, what are they doing now? I mean, a lot of them got really hurt because a lot of their properties they were renovating, they were the $40,000, $50,000, $60,000 homes. Well, what happened when they got dropped in half from a value standpoint? The bank said, you're upside down. You need to either pay me or we need to figure something out. And the CDCs were really stuck. And so it took a number of years to really start to see property values increase enough. But the CDCs, a lot of them closed their doors just because, there was nothing else they could do. They had these assets. The banks could foreclose on them, and they didn't have any income coming in because no one was really building over the past several years. And a lot of the folks that worked there moved on. They moved to the for-profit sector, or they moved somewhere else that was more profitable. So my favorite, probably my second favorite governmental program is the Low-Income Housing Tax Credit Program. And Michael mentioned it. Who here is familiar with the program and kind of how it works? Raise your hand. So a lot of you. So it's probably one of the best functioning programs, in my opinion, that the federal government has ever rolled out. It's created about 2.2 million affordable housing units since it was enacted in 1987. And it's a very simple principle. You have big corporations or banks that have huge tax liability. You have a lot of low-income folks. You have a dearth of affordable housing that's safe and decent. And so how do you marry those two together, again, to spur on investment, to create jobs in these low-income communities? Well, they created the Low-Income Housing Tax Credit Program, which essentially subsidizes affordable housing. And the reason being is if you're going to do a big multifamily unit, you're limited on the rents you can charge. So if you're a developer coming in and you're saying, hey, this is going to cost me $12 million to build this unit, well, I can only charge per the regulations or per what people can pay $700 in rent for those units. It doesn't make sense. You can't build it. You can't make any money on it. So they sell these. They receive these tax credits. They apply for them through the state. They receive a certain amount, and they're very, very limited. And they sell them to these investors like U.S. Bank or Wells Fargo, and they infuse equity, real money into those deals to ensure the costs of the overall deal is low enough where the rents can support the development. And they're not making people. I know there's all these reports that say, oh, these developers are making crazy fees. Trust me, it's not the case. I mean, they do make a fee on the upfront, but the ongoing ongoing, they're not making a whole lot of money, and they have to comply with all these regulations. And we've learned a lot from the past. There's been a lot of these types of projects where a lot of concentrated poverty in Section 8, and so they get a bad rap for some of the early projects, but we've learned a lot, and these are truly transformative. This is a project that houses veterans right next to the VA hospital. Swope Community Builders has actually built this. Really neat project, and so it's folks that are dealing with some stresses and mental illness from the war, and it literally is right, you can see the VA hospital, and they're able to work in conjunction with the VA hospital. So the 9% LIHTC, so the 9% are really the good ones. So that's the ones that'll help subsidize projects by up to 60 or 70%. But when you look at some of the projects being subsidized, if you've heard of all the schools, so 50% of our schools were closed in the Kansas City area. They're old historic schools. Well, what are you going to do with them? They're blighted. It takes a tremendous amount of money to renovate those and create an asset for the community. And programs like this provide the money so you really can renovate those. Because trust me, they're not going to be turned around anytime soon. They're just going to sit there for another 20, 30 years, or they're just going to fall in on themselves. So we want to turn them into a benefit using great programs like this. The competition for the state, unfortunately, there's some rural counties that don't use LIHTC as much, and so their senators are against it for whatever reason. So they've been some diminishing, they've diminished the amounts of LIHTCs in certain states. Again, CDBG and home funds, those are gap fillers for a lot of the projects. So when people come to me and they say, I look at what can we loan to them for these projects? Again, these are risky projects, but if there is a gap, we go to the city and we say, okay, can we negotiate something with the city? You have these funds available. I'm willing to put in from our CDFI X amount, but we need $500,000 in CDBG. Can we apply? This is a project that you'd support. So again, it really takes a layered financing approach to get these projects off the ground. There's a huge increased need for affordable units. I mean, if you're looking at about aging in place on the east side, there's some great pockets. The Palestine Church, they're doing some really good work for senior housing, because a lot of the folks that go to that church, they don't want to leave. They like that area. And so again, sometimes the seniors can't afford to keep providing repairs to some of their homes. And so we would try to help support those types of projects because we know that there's a huge need. I think all the senior projects that I've ever looked at are 99% leased up in those areas. So we know that there's a need. Oftentimes, when they're applying for the low-income housing tax credit program, there's some upfront costs. So, they have to apply. There's some money that goes into modeling. And so that kind of financing is called pre-development financing. It's difficult to secure. Oftentimes, that's equity that the proposed developer will have to put in the deal. LISC sometimes will provide the financing for that. There's political uncertainty. We all know Congress. No one can, agree on anything, quite frankly. And so, we have all those issues with these programs, and sometimes good programs get caught in the middle of those squabbles. Luckily, for the most part, low-income housing tax credits has support on both sides of the aisle, just because it has proven over and over again to be a job creator. Without it, you would not have affordable housing like we have today. I mean, it just, hands down, it doesn't work. And equity investors want limited terms. So in terms of equity investors, some folks want to they don't want to be in the project. So like low-income housing tax credits, an investor has to come in and be in the deal for at least 15 years. A lot of them want to get in and out more quickly. So that's a barrier. So how does LISC work with these market gaps? So a couple things that we do. We're more flexible than traditional banks. And I say that not to say the banks. Sometimes the banks want to do some of these deals, but they can't because they are more highly regulated. They're not, like a CDFI where we are created to fill these more risky kind of gaps. We use grant funds from foundations to help mitigate some of our risk. But so we can do things that just banks really can't do. We work closely with the city to bridge CDBG. So oftentimes it'll be, the multi-year CDBG grants. we'll provide that upfront money to get the project done. Or sometimes it's with foundations will come in and say, well, I'll give you 1.5 million, but it's going to be over 3 years. LISC will come in, provide the 1.5 million upfront for capital costs of a project, and then we'll get paid back from the foundation over the course of the 3-year period. We do provide grants for our early pre-development costs. We had gotten earmarks before they were a dirty word. And actually, Brownback gave us an earmark. So, I mean, we were doing some good work if Brownback gave us an earmark. And so he probably didn't want me to say that actually out loud. But he was a big supporter of ours, especially in KCK. And so that's also helped us to spur development in some of those areas. We provide loans up to 90% loan to value, which is, banks typically won't do. So we do, again, the hairy, risky stuff. And we don't call it risky because when we underwrite, we look at it differently. We have other resources that banks don't have. We have relationships with the city. We work very closely with Mayor James and Troy Schulte and his staff to ensure that we're all on the same page. And if a problem does occur, that we find a solution together, which is kind of a unique why LISC and all CDFIs are kind of unique because we enjoy that kind of really good relationship with the city. We'll capitalize interest-only periods, again, getting into some technical stuff. We are a patient lender. We have had deals that when the downturn in the economy occurred, we said, look, we're not going to foreclose. We know that you're on a path to success. We're going to help you. We're going to provide grants. And, we'll just freeze. This will be an interest-only loan for a couple of years until you start to pull out of it. We're not that type of lender that's just going to foreclose on these organizations. We have seen a 33% increase, though, in for-profit developers, which really speaks to the CDCs. And they lost a lot of capacity and space. And so some developers are coming in and really starting to look at low-income housing tax credits, where a lot of times it was just the CDC community driving it. We're seeing a lot of for-profits now working within the parameters of the program. And another program that we tapped into is called the CDFI Fund through the Treasury Department, the Bond Guarantee Program, which allowed LISC for the first time, to provide 30-year loans to projects that fit, that included affordable housing, to help reduce interest rates. This is the Faxon School. This is going to close next week. It's at 37th and Paseo. It's going to be an affordable senior deal. It's a for-profit developer called Sunflower Development Group. Jason Swords, if you went to the Downtown Council, just got an award as the Urban Hero. He does a lot of historic renovations. And so this is going to be a really neat, I think it's 52 units of senior affordable, and it also is going to include community space, which a lot of our projects also create that community element. And so here's my contact information, and thank you very much.
Well, thank you again to all of our panelists. I might pose a question before we open it up to the audience. We know from the research that our older adult population today and the older adult population we expect in the future is going to be very diverse in terms of their needs and their housing situation. But we also know nationally and locally that a very major share of those who are empty nesters, baby boomers today, or even older adults today, are living in their own home. And maybe with the exception of Pete's program, which it seems pretty clear about how the resources through that program can help an older adult or an older homeowner stay in their home. All of you have broader markets that you're trying to serve other than just the older adults. Can you maybe help us think about how communities and organizations that are trying to serve this growing older adult population, many of whom want to stay, AARP says 89% of all persons 50 or 55 and over want to stay in their home for as long as they can. What can they do in working with your institutions or organizations to help that part of their community live comfortably in their own home? Whether it's universal design, Michael, whether it's some loan products or support services. maybe help us sort of understand what opportunities there might be to help that segment of our current and future market.
Well, for us, you know, we get contacted quite often by people that are actually looking to downsize. So they may be in a home that's beyond what they can currently maintain, and so they're looking for something maybe a little bit smaller or more accessible. A lot of our older neighborhoods have the 2- and 3-story homes. Traversing those steps gets to be more problematic, or else they're just you know, want something a little bit smaller or more energy efficient. Almost all of our homes that we build, especially new construction, are ranch-style homes. I mean, they're all accessible. We don't necessarily call them that, but everything we do is built, so everything is on one level, including washers and dryers, and things of that nature. You know, we've also, in some of our older neighborhoods, you'll have a lot of older post-World War II homes, maybe the 2-bedroom, 1-bath, that a family isn't going to want to have. But we get contacted. We had a 73-year-old that bought one of our homes, and she loved it because it was just one level, just really small, really fit her needs. So it really gets down to what you said. There's a wide array of people in this senior housing market, some that want to downsize, some that just want something more universal, and then for those that want to stay in their homes, you know, I know there are programs out there to help, especially at the government level, with some owner-occupied rehab type programs. It's not something we necessarily get into as a CDC, but I know that there are several others that do.
I forgot to say one thing, because aging in place is important for our population, but sometimes it's not practical. And a reverse mortgage now in every state can be used to purchase a new home. So it's very important that you understand that, because sometimes regulations to buy or requirements to buy a new home conventionally, our older population don't meet those. They may have plenty of cash in the bank, but that cash does not count as revenue on a monthly basis, so they don't qualify for a conventional mortgage that way. So a reverse mortgage allows them to basically buy a brand new home, and they consume all of the money. Remember that we talked about they qualify based on the value of the home and their age. They just consume that money at the time of purchase. So in essence, they now own a new home for about half price, and they can move in and they never have another bank payment. So the long and short of it is, if they sold their old home, they can maintain some of that profit for legacy without having to go and use it all again to buy their new home. So that's something to think about.
And I had sat previously on the on Overland Park's CDBG Citizen Advisory Committee, and so that committee allocates funds to different organizations for different things, and one is minor home repair for aging and elderly folks in their homes through Johnson County, which was great, and I think they had received $150,000. I don't remember exactly what the qualifications were, but other cities have programs like that. So if somebody can't afford a critical repair to their home, they can work either through some of the nonprofit organizations like the CDCs here locally, and there's a list I'm sure on the city website, but here at Blue Hills, CHWC is in the back, Guadalupe Center, some folks that are more experienced in those programs and can secure some funding to help them, and especially in some emergency situations.
Well, why don't we open it up for questions from the audience?
Sorry, I wanted to clarify on a few things in the CHIP program that Leticia spoke to. The map is not in color, so you're probably wondering where in the world am I going to CHIP happen? Right? No, not the entire county, Michael, thank you. So east of 78th Street to the state line or the river, and you have to be 80% median income, and those change annually according to the HUD regulations. And we should know after our release of funds from HUD when we can release those. It should be the first quarter we're still anticipating. And we did change it to $14,999 as the maximum second mortgage amount. We had to lower that. But that saves you 5 years. So you save $1, it's a 5-year second mortgage. So you have to have your primary residency. So I just wanted to clarify a few of that. And then Michael, I wanted to ask you, for your preservation house, how did you handle SHPO on those windows?
Those are existing windows.
Okay.
So the one of the things, yeah, it's a challenge because you know you have lead-based paint mostly on a lot of these older homes, and so we end up having to strip those down, hire a separate company to come in, strip it down, and through working with the City of Independence, and then with the SHPO, we were able to secure. I mean, but it was a very expensive proposition compared to what you would normally do when you're trying to get energy efficiency. A lot of times you'll replace windows and put it in, but in this case, where it's in a historic district, it was designated historic. It's a block away from the Truman House. I mean, we had to adhere to every SHPO requirement, and that just meant more cost.
Thank you.
And for those of you that may not be familiar with SHPO, it's State Historic Preservation Office. Yes, Marcy?
I just want to comment. First of all, I want to thank Michael for the work that he's done in that house that he's talking about. Actually, is an eyesight of my home. I'm a councilman in Independence. And it has been a project of much labor and much love. But the work that they were able to do did so many things to improve the neighborhood. We actually worked on another house just around the corner, so another house just around the corner, so they're working on one adjacent to that house that you saw. But the improvement that it's made to stabilize the neighborhood has been phenomenal. One house occupied. I'm hoping we're getting close to maybe doing something with that house that we'll see. Yep, cross our fingers. But certainly utilizing funds in that way has made an extreme difference in our neighborhood and getting somebody into a home that otherwise we couldn't afford it, and taking properties that really were so far upside down in their value that we were able to stabilize them.
My question's for Michael and Chris in terms of your senior housing projects. Is that housing, is that for assisted living, or is that also subsidized housing units, or the market rates, or a combination of their own?
A lot of the senior housing, it depends on the program. I mean, if under the Neighborhood Stabilization Program, we were able to provide housing for seniors up to 120% of median income or below 50% of median income. So it went from 50% to 80% for the home program to 120% for some NSP funds. Our low-income housing tax credit project that we have down in Hutchinson right now, it will be for below 60% median income. A lot of seniors are living on fixed incomes, and so, you know, they qualify in essence most of the time for the senior housing. But most of it is, you know, there's a wide range, and really just kind of depends upon the funding source that we are able to secure.
Yeah, and the projects that we funded through that one developer, I mean, they have lower than market rents associated with that. Typically, they don't like to have a high concentration of like Section 8 or subsidized in those. It's mixed. There's usually a few vouchers, but again, not a concentration. Many of them also provide on-site services for the residents because they find that, you know, overall the maintenance is a lot less and functions better if, you know, so-and-so is getting their medication on time and, you know, or they're being helped with their bills and those types of things. And we're increasingly seeing that to be a very important part of a lot of the low-income housing or workforce housing that we're seeing. Is they partner with, you know, folks like Phoenix Family Housing, who does a tremendous job in providing, you know, care and support to residents of those projects.
And then, just to answer your first question, ours is all unassisted, so it's not assisted living of any sort.
Yes, sir.
Pete, I wanted to ask you, is there, here in the Midwest, is there a low-end optimum range that would qualify for these loans?
Well, reverse mortgage is all age-based. So it matters not what your income is, it matters not, we don't do credit scores at this time. We're not looking at debt ratio.
I'm talking about the home value though, is it?
Oh, well, again, it's FHA, the top side of FHA is 625,500. So I can do a reverse mortgage on a home up to that value, and if I do a reverse mortgage for a client above that value anywhere in the U.S., FHA caps me out at using home value of 625,500.
How about the low end?
The low end, we've gone down to $40,000, $50,000.
Right.
Yes, sir.
Thank
Another reverse mortgage question. If the home owner has equity in the home, significant equity, but the home itself is in, let's just say, actual dire need of repair, what effect does that have on the qualification process?
Very good question. It actually doesn't affect the qualification. What it does affect is when we can close the loan. The underwriter is going to determine, are there prior to close conditions that need to be repaired, or can we take some of the proceeds and set what's called a set-aside, which will be managed by an administrator to make those repairs after the loan is closed. And most of my clients appreciate that because most of them that sometimes they've not been able to keep up the maintenance of the home. So when the FHA appraisal takes place, the appraiser is going to make note of certain repairs. Some of those repairs can be done after the loan is closed, but what's nice about our class, we protect them because now a contractor is not going to get prepaid and not do the work. The work's going to be done, it's going to be re-inspected, and then they'll be paid from that set-aside reserve. And if some things need to be done prior to closing, we're able to work with the contractor to let them know they get paid at closing. So then the client who couldn't afford the new roof or to re-drill the well or to do whatever, sometimes we're able to work that out where it's done prior to closing, and then they're paid at closing, and we work with the contractors that way.
Are banks still required to conform to the Community Reinvestment Act, and if so, how are they doing it?
Yes, absolutely. They do it in various ways, to be honest with you. Some ways that they do it are they invest in us. We get grants from many of the banks that you see here for, for CRA. They invest in nonprofits that are doing community work. They do. So some banks, it's kind of interesting. Overall, I would say that many banks believe that satisfactory score is good enough, and they don't go the extra mile. There's a couple banks that really invest in community development work. The one that I think stands out, Wells Fargo just had was it a $3 million fund to help for homebuyer assistance? 4.5. 4.5. Sorry, he's on my board, so I had to call him. And Bank of America does a really good job as well, but a lot of local banks, they do invest in nonprofits that are doing work for CRA credit, and they're evaluated on a regular basis. All of those scores are public record, and you can find those on the Federal Reserve website. Federal Reserve also has several events in conjunction with FDIC where nonprofits can come and essentially provide a presentation to a big group of bankers, the CRA folks, and talk about their need, and that generates funding for those nonprofits. So, there's a lot of things going on. We're lucky to have a Fed here locally that can help facilitate that. So they've been really helpful.
My particular interest is co-housing, and for people that don't know what that is, because it's kind of a new thing, it's a small community of privately owned residences or condos with a strong communal aspect, and your Paxton project sounds like it edges toward that. It has some unique funding and establishment issues. Are you all seeing anything about co-housing or any interest?
I'm not that familiar with that phrase of co-housing. I think that some of the projects, the Bancroft School redevelopment project that was undertaken, does have a community feel to it. There's community gardens located. I think you're seeing more amenities, more opportunities for people to meet, like meeting rooms with these old schools. They have these big gymnasiums, and they're, how do you break them up? I mean, they have huge ceilings, and so what a lot of the developers are doing, which is very cool, is they are creating community space, and they can generate either income for the property, or they're having community meetings there, and so they're helping to facilitate kind of more community feel by providing those opportunities to residents. The Mary L. Kelly Center is another example where that has the community is able to actually do essentially work to join the community center, and they provide dance lessons. The Charlie Bird Parker Foundation is going to be there. A number of local events. There's a coffee shop there. And so that's another opportunity where you're seeing communities and neighborhoods kind of getting together to be more of a neighborhood than would otherwise you'd see by providing that kind of overall community center. Did I answer your question? No?
But, pardon? Talk about co-housing? Well, if you'll allow me a moment longer. Co-housing has what you said, that community aspect, but it's self-governed. So that's a unique aspect. Say a condo has a condo board that runs it. But in co-housing, the residents do the governing. They do mainly the maintenance. They're intergenerational communities, they're senior communities. I know the Palestine Baptist Church area, Missionary Baptist Churches, seems like a possibility, something like that, where people in that neighborhood might want to make that a larger kind of encroach, move in more closely. There's a community, 3 Trails and Independence that's forming. Low-income house, LIHTC, whatever, low-income housing tax credits are a great possibility and are used in co-housing. They're retrofit communities. Jean knows a lot about it. There are new communities, new development. We're starting a Kansas City Co-Housing Consortium coalition and invite more interest in ways that we can collectively put all the knowledge that, for instance, is in this room and impact successful aging and aging of all ages, make money for people, create community that is badly needed, people having a mutual support system, stuff like that.
Thank you. Paul?
Yeah, thanks, Marlene. I'd like to follow up a little bit on what Marlene asked at the very beginning, which is about, small grants, dollar-wise, $8,000, $10,000, $15,000 for people who really want to stay in their home, who are not necessarily downsizing. And I don't know if this is a Peter or Michael question, but I always get the question when we go and do some of this work is, how am I going to pay for this? Now, we are not a provider of that funnel of money, but it would be nice to be able to recommend some organizations who do have, not the big giant new housing, but people who want to stay in their home to purchase things like a ramp. I noticed on a couple of projects that you had, it was a highly graded property of 5 steps. You only had one that was a single step up into a home with no ramp or accessibility into it. The people that I work with are mainly interested in staying in their home, but they have to change their housing in order to be able to stay there. Most of those issues are about entry and egress, and then having a bathroom and kitchen that functions well for them. So they're not looking at purchasing a new home, they're just wanting to keep the home that they've got, but how do they get a smaller amount of dollars in order to get that, make that accomplished?
Well, with my program, it's pretty easy. They tell me how much they want at closing. They qualify for a pile of money, and then they have the option, do they want any of that at closing or leave it all in a line of credit? So in that case, if they wanted $5,000, they would just get that at closing 3 days after the rescission period's over. They'd get that, and they could pay off who the contractor was. And that's kind of why I got in Certified Aging in Place Specialist. When the National Home Builders Association gave me that designation, because I wanted to learn more about universal design, I wanted to learn more about that, because we have a lot of clients, and I would say less than half of my clients take money at close. Really, you need to think about this as a funding longevity tool. So as I said, with that line of credit, they can at any time in the future borrow what's necessary to do any home modification.
Well, so they have to go through a process, loan origination and qualification in order to get all that. If they're not interested in doing that, what options do they have?
I wouldn't be able to help them because they have to go through the counseling, and because it is a loan process for me. Now it is.
I mean, there their spouse is coming home from the hospital in 2 weeks.
Yes.
And I've got 2 weeks to put in a new bathroom for them in order for them, because the hospital says I can't release them to their home,
Right.
which is where they're going to recover, until I get this ramp and this bathroom. They've got 2 weeks to get this done.
I've helped a lot of clients with that, but you're still looking at, in that case, I would have to start the process in 3, maybe 4 to 5 weeks we could fund the loan, but in that case I would talk with the contractor and make sure that he gives us the invoice and then he'd be paid at closing to be able to make that modification so they can move in. And I've had to do that with quite a few clients.
I might say to partially address that, the United Auto Workers has a volunteer program. Well, they will come out and actually build a ramp. I understand there is a waiting list, but when we contacted them, they came out within a couple of weeks, and they built it at no cost to the tenant or whoever the homeowner is, just based upon need. It's a fabulous, they did a fabulous job. It took them about 4 hours. It was incredible. So if you give me your card, I can give you that contact information. The question that I had was about the 89%, you said, Marlene, of folks 50 to 55 plus want to stay in their homes. If we're talking about senior housing on the east side in particular, where do we go to find demographic information that might feed a market study to help us?
Well, the American Community Survey, which is administered by the Census Bureau, is now looking at more local and more current data about populations in neighborhoods, and so you can get that data at the census tract level. You could contact our research center. Many of the local governments have access to the data for their communities, and so that would be a good source of information about looking at older adult populations, older homeowners, people by income, that could help you in your market study.
Thank you.
A question for Pete. As you mentioned, housing counseling is really an important component. Like counseling agencies, how many hours are required, and how is over-the-phone counseling working, or how does it work?
It's a great question. It is a mandated process because I can't get an FHA case number without a counseling certificate number.
Right.
It is a neutral third party. The reason over the phone has had to happen is because we don't have as many face-to-face counselors in certain zip codes, and making our population travel for hours just to go sit for a 45-minute counseling session isn't always convenient. So over the phone for me has worked just fabulous because our clients are able to stay in their home at their leisure, and they're able to have both parties on the phone, whether it's speakerphone or not, and it seems to work really well. And from every bit of information I get, both from the counselor after the counseling session and from the client, it's been a good time for them to both question the program, question themselves to make sure this is the right step for them.
Yes, sir.
Pete, I don't understand how you make your money.
That's a great question. Everybody says it sounds too good to be true, so it is. Everybody knows about mortgage insurance, correct? So if you borrow, what is it, 80-20, if you borrow more than 80% on your home, you have to have mortgage insurance to protect the investor, right? So in case that loan defaults, you're able to be made whole, right? There's an insurance plan. And as you pay that mortgage balance down at 80% or less, then you can get rid of your private mortgage insurance, correct? Well, with a non-recourse reverse mortgage insurance is in place the whole time of the life of the loan because it's a negative amortization loan. Since the client's never paying anybody, there is a fee that's collecting every month, 1.25%, which will cover me in 25 years when the house is sold. If the house sells for $100,000 and I'm owed $200,000, I'm able to collect a little bit of the money that I'm owed, but I then take the sell HUD receipt and I go to the mortgage insurance pool and I say, I am owed another $100,000, the mortgage insurance makes me whole. So worst case scenario, the reason we don't mind waiting for our money, unlike the forward mortgage, we're guaranteed to make all of our money. In a forward mortgage, there's risk, and the idea of mitigating that risk is monthly payments offset the balance at the end. Does that?
Sort of.
Well, if you loan me money today and I give you a guarantee that no matter what happens to me in 20 years, I'm going to give you everything you're owed, plus interest, and you can take that to a third party that has more money than I do that's carrying the insurance policy, that's really what it is. It just allows us to be comfortable not taking any monthly proceeds because we know we're going to be paid in full whenever that day comes. But that's why we loan less money to younger people. The older you are, the more money you get because we need that delta between loan value and future sale price of the property.
Thank you.
Yes.
I had a question about, say you have a client, this is for Pete, again, about reverse mortgage, a client with some cognitive decline and how the counseling works in that case. Like if you have a family involved and they might be able to afford some extra care at their home with the reverse mortgage, but the person who owns the home may not have the cognition.
Yeah, sure. It happens all the time. And that would be where a POA would be present, if there's a power of attorney. Now, with a power of attorney, there's going to be specific guidelines about who got the power of attorney and when they got it, and what the state of mind was the person that gave it up. Because there's a lot of fraud, or has been fraud in the past with POAs. So now you've got to have a letter that from a doctor that certifies that the client was of sound mind when they gave their power of attorney to whoever they gave it to, and then we're going to need a letter also at the time that that person uses that power of attorney on behalf of that client, and then they would be the ones that would be actually going through the counseling if there's a POA. At that time, the PAO would do the counseling, the PAO would be signing all the paperwork on behalf of whoever they're holding the POA for.
Thank you.
Yeah.
Bill?
I've got a question for Chris on the low-income housing tax credit program. Is that a state-funded program or is it a federal tax credit? And I'm not quite understanding the 9% and what that refers to.
So it's both, but mainly it's the 9% credit is a federal tax credit. And so each state is allocated a certain percentage based on some equation with how many low-income people they have in that particular state. Missouri, because the population is more than Kansas, has a bigger allotment of those funds. They're spread throughout the entire state, and so anyone can apply for the tax credits. Typically, on the 9%, which is what everybody wants because it's the biggest subsidy, and you get the biggest deal done with them. We get, what do you think, Erica? 2 projects a year in Kansas City, 2 to 3, depending on size. Of 9%, and again, that's more of like a 70% subsidy when you're building. So the projects that need a much higher subsidy because maybe they're older buildings that have historic designation and they're just so costly. And again, the rents, they can't charge the rents that you typically see, and so that is provides significant subsidy to get some of those deals done. An example, Erica, what are some good examples of 9% deals?
I'm Erica Dobrev, and I'm president of the Kansas City Equity Fund. We invest in low-income housing tax credits. In Kansas City, Missouri, some really visible properties that you've seen. I'll just be very self-serving and say that there's the Valentine Apartments on Broadway. Right now, we're investing in the Colonnades at Beacon Hill, which is the 27th of the Paseo. And I can tell you that if you want some really in-depth information, I'd really be happy to chat with you. It's pretty hard to explain the tax credit program in 30 words or less.
The 4% credits are, I would say, more abundant, but they are harder. It's harder to use because you have less subsidy, and so those a lot of times are just used to rehab existing projects that are coming to their useful life, and so they'll apply for those and maybe some additional subsidy that'll help renovate and get a particular project up to just.
It's pretty common to use the 4%, and the 4% and the 9% mean something technically, but let's just say the 9% are competitively awarded, and the 4% credits typically are not. It's pretty typical to use those credits, that we call the 4% credits, in conjunction with historic tax credits, because that gives you a better income stream. And really, the tax credit is just that, it is equity. It provides equity in the deal so that it lowers your debt, and that's why the rents can be lower.
Mm-hmm.
But I do have to say on that.
And is it accurate that the state of Kansas doesn't have state income tax credits? So
Yeah, the low-income housing tax credit program is a federal program. However, there are a number of states, including Missouri, but not including Kansas, that also has a state low-income housing tax credit. It is added on to that as well, so it gives you more equity.
one question, I guess, for Chris and maybe Erica, you might help with this, and that is the certified financial or certified development financial institution, the CDFI designation. You mentioned that it's only available to distressed areas. I know LISC mainly works in Kansas City, Missouri, and Wyandotte County. Are there, would the criteria enable portions of some of our older suburbs to perhaps look at that as a tool to help them? And you mentioned it's available for both commercial and residential.
Yeah, so LISC is really more limited by staff than geography. So there's plenty to do in KCMO, as most of you know, and in KCK, and so we have, other cities have said, can a LISC work in, independence? And we said, we'll say, well, sure. However, we have to, we would have to have another staff member, which oftentimes we're funded locally. All of our operations are actually funded locally. A lot of people think because we're a big national organization that we're funded through that, which really is not true. We fund almost all of our operations 100% here locally, and then we leverage other federal and national funds to invest in communities. But that's kind of how LISC works, is we have to be brought to a community and there has to be a commitment from the community to leverage the national resources. And so we have looked at deals here and there. I wouldn't exclude it, but I'd say it's mostly a staffing issue than anything else.
And there are other CDFI organizations in the Kansas City area.
So a few other, we call it friendly competition because we're all here to support the deals. And so Central Bank of Kansas City is actually a bank CDFI. They're a specific designation. There's only about 80 of them nationally, but they are both federally regulated and also a CDFI. And they work in all over Missouri. They actually have branches in St. Louis as well. Erica is a CDFI, and she does, you can talk about the ones.
Okay. I can describe what a community development financial institution is. And it is a designation that the U.S. Treasury provides to for-profit and not-for-profit entities that provide services and lending to underserved markets. And the Treasury defines an underserved market not only as a geographic area, but also as a product. And the type of products we're talking about today, affordable housing, is an underserved market. So LISC, we serve target market areas. We have to sort of designate what areas we want, but those are relatively broad. But then also the products that we provide. So there are, a few. I wouldn't say that there's an abundant number of community development financial institutions in the Kansas City metro, but there are some. There are a few.
Yeah, we're fairly limited here locally compared to some of the other, like the bigger cities. Even St. Louis has a number more than we do. We only have 3 at this point, and so. Although we work in many facets, so there's other programs we have for like expansion of federally qualified healthcare facilities. We have a national fund that just does that. It's just to expand FQHCs or healthy food financing initiatives. We have funds that are designated just for grocery store or fresh food retail type projects, and so those we are a little more flexible on than our core products, but. Yeah, the CDFIs, they're a good tool for a lot of folks.
Some CDFIs provide solely small business loans or micro loans. They're not in our type of housing business at all. So it's a pretty broad designation.
Okay. Thank you. Other question?
As the population of seniors grows, do you see a new market developing where there's a law to stay in place and companies to do the rehab necessary to allow that to happen?
I mean, personally, I think it has to happen. There's no way that we're like in this crazy multifamily boom right now, where every developer and their brother is building multifamily, but seniors are a totally different case. There's just, they're going to have to figure out a way to modify existing homes for seniors. Someone's going to have to come up with something, or if maybe it's a federal government program, but not everyone can just move to a retirement community. A, it's expensive, and B, they just can't build enough.
It's at all economic levels.
Yeah, sure.
Selena?
Do you find that collaborations with public or private funding increases if you can identify amenities that are simultaneously being built, or do you work in conjunction with other developers who are not building the housing but the necessary, like you said, grocery stores or clinics that are required for aging in place? They can't stay if they can't get to the necessary community needs.
I can talk to, so LISC, we're kind of involved in everything that we can get involved in. So we, whether it's grocery store access and fresh food, whether it's supporting developers that are creating wraparound services for folks. We're all about bringing people together to help build community, because we believe that community is not just housing. We just did housing for a number of years, but we really expanded our reach into what we call quality of life planning in different neighborhoods. So we look at funding education. We spent $15 million on education supporting reading programs over the past 7 years. That's a huge directive. Building better schools or expanding different schools. Crime and safety, we've secured $1 million grant from the federal government to help with crime and safety along the Prospect Corridor and in the Northeast. So we look at it more comprehensively, for sure, absolutely, and we try to bring all those folks together. Senior housing has not necessarily been a major focus historically. However, I see that changing because of the population, and so I think we'll see a lot more programs nationally that help support those types of efforts. And so yeah, the answer is yes. We absolutely are involved in a lot of different discussions and trying to bring different actors together.
Yes.
Pete, you mentioned the CAPS program offered through NAHP. Does the local Kansas City Home Builders Association offer some support for that, or contractors that work on rehabbing and that kind of thing?
I'm not 100% sure. I know that I took the class locally. The speaker was a national speaker. But they do a lot of, even for me, they give me a lot of support every week with materials, education, and also how to market and how to do and get more in front of those people. Because I think what happens is a lot of people that can do the handy work to do the modifications of the home aren't always the best marketers and aren't always the best bill collectors, and all, because my sister, for example, had her house painted and I don't think she's ever gotten a bill for it. So they're trying to help those things, but that again also comes back to where I like our situation, because if it is something that's involved with our loan process, we're kind of stabilizing the money until the job is done. So I do like that approach.
Our main office is in the Home Builders Association office, so we deal with builders and small rehab companies all the time. The challenge is when the bust hit, a lot of contractors went out of business. Now that things are starting to pick back up, it's hard to find good qualified small contractors to do the small stuff. To do, you can find an HVAC company come in, replace the system, but if you need to widen a door and things like that, it's a challenge even for us as a not-for-profit working in the home builders, just because the contractors, a lot of them went out of business and went to do something else, and they haven't come back yet. Now, I'm not sure if there's a list there or not, but Sarah Corliss is the director. I would contact her to see if she has a list of, and I'll see her this afternoon, so I'll make mention of it. See if there's a list of small contractors that are willing to do that.
There were several contractors in my class, so if you go to the national site, they actually have a list of everybody that has the CAP certification as well.
Is there not a local association of rehab contractors?
There is.
But this is different, I believe, than
just understanding probably what needs to be done in the home, and being accustomed to working with older folks. And not taking advantage and being courteous and
Well,
respectful and that type of thing.
and I think CAPS, what I liked about universal design, it's not institutional design. And so many contractors think throwing a handrail up in a bathroom is going to make it functional. And that may be code, but it's not universal design and it's not functional. So there's a big difference between going in and making handicap compliant versus making it livable.
So I'll ask a question, and it might be perhaps our last, and that is that in the room there are a number of representatives from local communities or organizations that are today serving older adults or expect that those they serve, the share of those they serve that are older will increase in the future. And what could they do? I mean, obviously they can create stronger connections with you and your organizations, but what can they do as an organization or as a local community to better prepare their communities to help residents, whether it's age in place or to find a more appropriate housing option within their community? And so is it establishing, a stronger relationship? Michael, you mentioned you've been working with a number of local communities, and Chris, you mentioned, but for staff, you would have the opportunity or the interest in serving more communities, and that you already work with lots of organizations. And Pete, and Leticia, it sounds like you're doing a lot of education about the resources your respective companies offer. So maybe sort of helping the audience as they leave today think about what are steps they might take that would help them in better serving the people in their communities or the customers, the clients for their organizations.
Well, from our perspective, Village Development Corporation, we do work with many of the cities that are even here in the room. The thing I think that as a takeaway is if you haven't started planning for this, now is a good time to start. Figure out what the need is going to be, determine the need, and then you can kind of wrap your head around what kind of resources might be out there in order to accomplish some of what you need. Now, we can help with the resource side of it sometimes, and some of the expertise side of it, but really it's up to the cities to take that first step and start planning for this incoming population or growing population more than incoming that is going to be a big need in the future.
I think one, parting idea is just to be aware how your city is allocating and spending community block grant dollars. It's pretty common, and while it's very, it's an eligible expense, it's very common for cities to use those funds instead on minor home repair for folks that either can't afford it or the elderly, to use it on curbs and gutters and other public works and infrastructure. It's a very common practice, especially with smaller cities. And as the need grows, I would say that maybe cities should take a look at whether or not that's the best use of those funds, or whether the best use of funds is try to keep people in their homes by renovating or doing what they need to maintain a solid housing stock. That's one. The other thing, there was a really interesting article in the paper the other day about folks that pass away and don't have the deed, the right planning. There's a very quick deed that they can fill out. I think they said that it takes a half an hour to fill this out. That'll help cut through a lot of red tape and expense from the city standpoint in transferring a home to somebody. So we're thinking about putting on some seminars in the future to help folks do that, because once it gets into the city and the gridlock and taxes and all that kind of stuff, a lot of times the kids walk away from the home and wash their hands of it, and then folks come in, it sits there, it gets stripped, it just adds to blight and cost to the city. So that's another thing that I think can be done.
Well, why don't you join me in, again, thanking our panel this morning. And I would like to turn this over to Kathy Boyer-Schessel.
I also have to please thank you for our presenters, and housing is so fundamental to aging in place, and so I'm really grateful that so much of the discussion today brought up issues related to aging in place, and with housing, financing is such a critical issue. Obviously, there's so much interest today. So we tried to bundle a variety of topics that we thought would be helpful. So I just want to say to each of the presenters, thank you for number one, your efficiency, and for all 4 presenters to be done in an hour so that there could be so many really great questions. Thanks to each of you for what you brought today. And thanks to those in the audience, too, that brought some additional expertise, co-housing, some other lending. So thank you for helping to make this workshop even to develop our capacity for that. So thanks again. And I also have the honor to give some closing remarks as you fill out the participant evaluation that's in your packet. So if you don't mind taking a minute to fill that out, because that information is really important to us. KC Communities for All Ages and First Suburbs Coalition are interested, as it's been brought out today, in supporting our region's understanding and involvement in age-friendly communities. So if there's a topic area that you would like to further explore, please just turn your evaluation over and let us know what other kind of topics that you would like to have us bring to you. And if you have a particular expertise in helping to share that information, please include that as well. Today's presentation is being videotaped. This will be on, I know it's on KC Communities for All Ages website, and I believe the First Suburbs Coalition's website as well. We'll send an email to everyone who's here today, letting you know when the videotapes are available, and then the presentation and all of the handouts will also be available for you, or if you want to share those, forward that to any of your colleagues or individuals that you think could really benefit from the information that was presented today. We really encourage you to do that. I also wanted to just mention that KC Communities for All Ages and the First Suburbs Coalition partnered together to develop an idea book for homeowners and others that really focus on universal design and rehab suggestions. I can't believe that we didn't think to bring a supply of those today. Those are on our website, and I will include that on the email that we send to you with the information about today's workshop, so that you have the link to that idea book. I'll also include a link to the Certified Aging in Place questions, because I believe that there is a website that lists how you can find out the CAPS certified people in particular regions. So we'll include that on the email as well. It sounds like there was interest in that. We're also hosting a universal design workshop in May. We don't have the actual date yet, but I can assure you you'll get the announcement of that workshop when it's scheduled. So I just want to thank you for your time and interest in being here today. Really appreciate it. And just one more time, if we can thank our great presenters.